And also keep in mind that if your total income, right, including your salary, and then when you add interest to it, if that is crossing 300,000 rupees or 330,000 rupees a month, you're effectively going to pay 36% on your FD interest, right? That's basically wiping away more than 1/3 of your interest income, right? So effectively think about it like this. If you're falling into that 300,000 income category, right? If you make 11% on your FD, after tax, you will only get 7% to your hand, right? And your inflation, which is at 5%, right? So you're only getting, if you numerically work it out, you're only making about a 1% premium over the inflation rate on FDs, because that's what you're getting to the hand is only about 7% interest rates as cash, right? And this is only applicable if you're falling into that 36% category. But now we see most of the people coming to the 36% category, because if your salary automatically crosses 100,000 or 200,000 range, and then you're making an additional component on fixed deposits, that automatically normally tends to go into the higher brackets, right? So because of that, right, your after-tax FD returns are now looking very bad or not lucrative if you're falling into that tax category, right? So our suggestion, so moving on. So our suggestion would be the unit trust products, right? Now, why I've explained what a unit trust is. It's a pool of, we pool funds from multiple investors and park it in various instruments, giving you a consolidated return, a weighted average return of that portfolio. You can even start small, even with a low amount if you want to, right? But I understand the question that you all would have in terms of how unit trust can give a very high return, right? Now, these returns that we put in here are the returns over the last 2 months in terms of what our monthly annualized return was, right? This doesn't mean that we're going to continue at these kind of rates, but we will be able to provide a return way higher than what the banking system will provide for the next 12 months at least. And I'll tell you why, right? So the reason why we will be able to kind of provide a higher rate is because of a maturity profile, right? So what we've done is strategically parked a large part of our money in long-term instrument when rates were high. So what we've done is we made a call. We saw these interest rates were going to come down. So as an investment company, our unit trust arm did one thing where they parked roughly about 46% of the fund in long-term treasury and corporate debt, right? Which is yielding very high returns, right? So now you locked in 40% of your fund in very high returns, right? So if you wait the returns out, you'll still be able to enjoy a 20% plus return for the foreseeable future, for at least the next couple of months for sure, right? Unless we've seen a doubling or tripling of cash inflows coming to the market, we still can comfortably give a 20% plus return for the next couple of months, right? So our advantage and why we are able to give a higher return compared to market is because of a call that we made on interest rates, and our fund has locked in a large part of our portfolio in high yielding fixed income instrument over the last 3-4 months, right? So also keep in mind, there is a tax play with the unit trust as well, right? So in FD, every time you get interest, right, you have to pay taxes. The 36% tax is applicable on the interest that you make, right? But and how the taxation works in Sri Lanka is on realization, right? When you're getting interest to your hand, you need to pay taxes, right? But with a unit trust, right, because you're not getting the interest to the hand, if you say, for example, if you put money in the unit trust, and if the interest is just accumulating on the fund without you withdrawing the money, right, you can postpone this tax payment, right? So effectively, you're not realizing the cash flows. If you take money and just park it in the unit trust, and unit trust is earning the interest, and the interest is accumulating in the fund, and the unit price is every day going up, right? So if you don't withdraw the cash, right, and keep accumulating money in the unit trust, right, you can postpone this tax payment, right? So for example, we've shown an example where on a 20 million rupee deposit, right, say the rates were 25%, you make a 5 million interest, right? On that, every year you have to pay 36% tax, right? And we've shown a scenario how your tax changes, right? But here also we show a scenario where if you keep the money in the FD in a unit trust income account, right, even if you have 20 million, which is making you 25%, the 5 million interest, if you're not withdrawing the money amount, right, you don't have to pay taxes on those years, right? You will only pay, say, for example, you keep accumulating in the account without withdrawing it, you only have to pay tax at the point of withdrawal, right? If you keep for a longer period of time, right, you pay for the cumulative layers, but you have a time value of money because your cash is not going out as of now, right? So we are postponing your tax payments, right? And sometimes there's a very likelihood chance that given that the government's collections are not too great, they might look at just increasing the WHT or the withholding tax on or implementing a withholding tax on or increasing the withholding tax on bank deposits and unit trusts and so on. And they might take out the option of having an income tax of 36%, right? Because collections are going to be difficult in terms of income tax. So if you feel that income tax on FDs and so on is not practical and it's going to come down in the future, you're actually better off keeping the money in the unit trust, because at the point of redemption or withdrawal, you only pay the tax rate which is applicable at that time, right? Say, for example, if in 2 years' time or 3 years' time, this 36% becomes 12% or 15%, right? So you don't have to pay 36% on each year. You will only pay the 15%, which is the rate prevailing at that time as the tax component, right? So effectively, you save a lot in terms of the taxation in the future, right? So one thing is, if you don't have money that you want to use on a day-to-day basis, you can postpone the tax payment, right? You can postpone the tax payment by investing the money in the unit trust, right? So two benefits from the unit trust. One is that you're earning a higher return because of an advantage of being able to lock in large part of a portfolio into long-term instruments. Second is that the tax benefit that you can make by postponing your payment, right? So these are two key benefits by what you will see with a unit trust product. So just to talk a little bit more on the unit trust, our unit trust, we've been operational since 2012, right? Our returns have been always greater than what you would make on FD, fixed deposit. And this, in addition to the liquidity that you get, because in a unit trust, you can withdraw money whenever you want, right? So you might have a question in terms of, okay, if everyone's asked for money, how do you pay it if you have large part of your portfolio locked in long-term securities, right? The thing is, these long-term instruments are more liquid, right? So we can short it, we can sell these long-term instruments, and they're already on a gain, right? So we can kind of capitalize on these long-term products if we require. So there's no problem with liquidity as such, right? And over the years, we have kind of, if you look at AWFDR is basically the bank deposit rates, average weighted fixed deposit rates for each of these years. And if you look at it, the three funds that are shown are the investment grade fund, CAL Income Fund, and the CAL Fixed Income Opportunities Fund. The Fixed Income Opportunities Fund was only launched in 2022, which is why the purple bars are only visible from 2022 onwards, right? But overall, we've been historically outperforming the market. And that's because of our investment, where we have access to better investments that as a typical retail investor, you won't have. And second is our timing of markets. We understand these markets better. Our macro timing is better, which allows us to make decisions on behalf of you. So you really don't have to worry about picking where the rates are better, what is the credit quality of these instruments. We do that for you. We do that evaluation, and we create a pool of assets that you can directly invest in through a unit trust product.